The date is January 9th, 2026, and Americans are waking up to a reality that most did not anticipate. 5 days ago, the United States military executed one of the boldest operations in modern history, extracting Nicolas Maduro from the heart of Caracas in a surgical strike that has rewritten the geopolitical map of the Western Hemisphere. The headlines have been dominated by images of stealth helicopters and the diplomatic fallout. But beneath the surface of this strategic triumph, a different story is beginning to unfold. It is a story that will be told not in the situation rooms of the Pentagon or the editorial pages of foreign policy journals, but at the gas pump, in the grocery store, and on the monthly bills that land in millions of American mailboxes. The question that is now rippling through the financial markets and the corridors of economic power is deceptively simple. What does regime change in Venezuela actually cost the American consumer? The answer is far more complex and concerning than most realize. This is Professor of Money, a place where money moves nation, power bends truth, and history hides its darkest secret. To understand the economic shockwave that is about to hit American households, we must first grasp the scale of the Venezuelan energy sector and its role in the global oil market. Venezuela sits atop the largest proven oil reserves on the planet. The official number is staggering, approximately 303 billion barrels. That is more than Saudi Arabia, more than Canada, more than Russia. It is roughly 18% of the entire world's proven reserves concentrated in a country the size of Texas and Oklahoma combined. But here's the cruel irony that has defined Venezuelan economics for the last decade. Having the oil in the ground means nothing if you cannot get it out. Under Hugo Chavez and Nicolas Maduro, the state oil company PDVSA was systematically destroyed. Experienced engineers were purged and replaced with political loyalists. Maintenance was deferred. Investment collapsed. Corruption drained billions from the system. The result was catastrophic. In 1998, when Chavez took power, Venezuela was producing 3.5 million barrels per day. By 2020, that number had collapsed to under 400,000 barrels per day, an 88% decline in production despite sitting on the world's largest reserves. The American military operation has now added a new layer of uncertainty to an already fragile situation. In the 72 hours following the strike, Venezuelan oil production did not stop completely, but it has been severely disrupted. The workers at the refineries and the oil fields are waiting to see who will be signing their paychecks. The logistical networks that move crude from the interior to the coast have been thrown into chaos. The initial reports suggest that production has fallen by an additional 30 to 40% in just the first week of the crisis. Now let us connect this to your daily life. The United States imports approximately 7.9 million barrels of crude oil per day. Even though domestic production has surged thanks to the shale revolution, making America technically energy independent. In some years, the U.S. refining infrastructure is not designed to run exclusively on light sweet American crude. The refineries along the Gulf Coast, particularly in Texas and Louisiana, were specifically built to process heavy sour crude. That is exactly the type of oil that Venezuela produces. Before the collapse of the Maduro regime, Venezuela was exporting roughly 200,000 barrels per day to the United States, down from over 1 million barrels per day before sanctions. That might sound small in the grand scheme, but in the tightly balanced global oil market, even small disruptions have outsized effects. The immediate impact has already been felt. In the 5 trading days since the operation, the price of West Texas Intermediate crude has jumped from $71 per barrel to $79 per barrel. Brent crude, the international benchmark, has spiked to $83 per barrel. That is an 11% increase in less than a week. Here's how that translates to the pump. For every dollar increase in the price of crude oil, the national average price of gasoline rises by approximately 2.5 cents per gallon. An $8 increase in crude translates to roughly 20 cents more per gallon. If you fill up a 15-gallon tank once a week, that is an extra $3 per fill-up, or about $156 more per year. Multiply that across 276 million vehicles registered in the United States, and you're looking at $43 billion extracted from consumer spending annually if prices remain elevated. But gasoline is just the beginning. Oil is the lifeblood of the modern economy. It powers the trucks that deliver goods to stores. It fuels the ships that bring products from overseas. It is a key input in plastics, fertilizers, and pharmaceuticals. When oil prices spike, inflation follows like a shadow. Economists call this a supply shock, and it ripples through every sector of the economy. Let us look at the grocery bill. Transportation costs for food distribution are heavily dependent on diesel fuel, which is refined from crude oil. A 10% increase in diesel prices typically translates to a 2 to 3% increase in food prices within 60 to 90 days as the costs work their way through the supply chain. For the average American household that spends $8,000 per year on food, a 3% increase means an additional $240 per year. Combine that with the increased cost at the pump, and we are already looking at nearly $400 per household annually. Now we must consider the broader macroeconomic effects. The Federal Reserve has spent the last 2 years fighting to bring inflation down from the 9% peak of 2022 to a more manageable 3%. They have done this through aggressive interest rate hikes that have made borrowing more expensive. Just as inflation was finally cooling and there was talk of potential rate cuts in 2026, the Venezuela operation has injected a new source of price pressure into the system. If oil remains elevated and inflation ticks back up, the Federal Reserve will face an impossible choice: cut rates to stimulate growth and risk reigniting inflation, or hold rates high to contain prices and risk pushing the economy into recession. For American consumers, this means that the cost of everything from mortgages to car loans to credit card debt will remain painfully high for longer than expected. Consider a family with a $400,000 mortgage at a 7% interest rate. If the Fed had cut rates by half a percentage point as markets had been expecting before the Venezuela crisis, that family could have refinanced and saved roughly $100 per month or $1,200 per year. If rates stay high because of oil-driven inflation concerns, that savings evaporates. The stock market has also reacted with volatility. The S&P 500 dropped 3.2% in the first 2 days after the operation, as investors priced in the risk of higher inflation and prolonged high interest rates. For Americans with 401k retirement accounts, which now hold over $7 trillion in assets, even a modest sustained decline in equity values can erase tens of thousands of dollars in retirement savings. Then there is the geopolitical risk premium that is now baked into every asset price. Markets hate uncertainty, and the Venezuelan power vacuum is a textbook case of uncertainty. Will the transition be peaceful, or will it descend into civil war? Will Russia or China attempt to destabilize the situation through proxies? Will Colombia and Brazil be drawn into a regional conflict? Every one of these scenarios carries an economic cost that will ultimately be borne by consumers and taxpayers. We must also examine the Reconstruction Bill. The United States, having removed Maduro, now owns the responsibility for what comes next. The Venezuelan oil infrastructure is in ruins. The electrical grid barely functions. The water systems are failing. The hospitals lack basic supplies. Rebuilding a failed state is not cheap. The reconstruction of Iraq cost American taxpayers over $60 billion. Afghanistan cost over $140 billion. Venezuela, with its larger population and more complex industrial base, could easily require $50 to $100 billion over the next decade. Where does that money come from? It comes from the federal budget. And when the federal budget is already running a deficit of nearly $2 trillion per year, every additional dollar spent on foreign reconstruction is either a dollar added to the national debt or a dollar taken from domestic programs. The national debt currently stands at $36 trillion. The interest payments on that debt are now the fastest growing part of the federal budget, consuming over $900 billion per year. That is more than the defense budget. Every additional dollar of debt means more interest payments, which means higher taxes in the future, or cuts to Social Security, Medicare, and other programs that Americans depend on. There is also the question of migration. The collapse of Venezuela under Maduro drove nearly 8 million people out of the country, the largest refugee crisis in the Western Hemisphere. A new wave of instability could trigger another surge. The cost of processing, housing, and integrating refugees falls on American cities and states. New York City alone has spent over $2 billion dealing with the recent migrant surge. If the Venezuelan situation deteriorates, those costs could multiply. But let us consider the optimistic scenario, because it is not all doom and gloom. If the transition succeeds and a stable pro-American government takes power in Caracas, the long-term economic benefits could be substantial. A rebuilt Venezuelan oil industry could add 2 to 3 million barrels per day to global supply within 5 years. That would put sustained downward pressure on oil prices, potentially driving gasoline below $3 per gallon and saving American consumers billions annually. A stable Venezuela would also become a massive market for American goods and services. Before the Chavez era, Venezuela was one of the top importers of American products in Latin America. A revitalized middle class would once again buy American cars, appliances, and technology. American energy companies like ExxonMobil and Chevron, which were expropriated by Chavez, would return and invest tens of billions in new projects, creating jobs both in Venezuela and in the United States. Furthermore, a democratic Venezuela, aligned with the West, would remove a major source of instability in the region. It would cut off the flow of drugs that currently cost the American economy over $200 billion per year in healthcare, criminal justice, and lost productivity. It would reduce the need for expensive military operations and intelligence gathering in the region. But all of these benefits are conditional on success, and success is far from guaranteed. The next 90 days will be critical. If the Venezuelan military fractures and paramilitaries launch an insurgency, the costs will skyrocket. If Russia and China decide to make Venezuela their line in the sand and pour resources into destabilizing the transition, the conflict could drag on for years. American consumers are now hostages to the success or failure of a geopolitical gamble made in the pre-dawn hours of January 3rd. They will pay at the pump. They will pay at the grocery store. They will pay in higher interest rates and lower investment returns. They will pay in taxes to fund the reconstruction, and they will pay in the opportunity cost of what those resources could have built at home. The invasion of Venezuela, though not called an invasion by the administration, will be measured not just in strategic victories or diplomatic wins, but in the monthly household budgets of 330 million Americans. The price of regime change is not an abstract figure debated by economists. It is the difference between affording a family vacation or staying home. It is the choice between repairing the car or putting it off another year. It is the slow erosion of purchasing power that families feel, but cannot always name. As we move deeper into 2026, every American should be watching Venezuela not as a distant foreign crisis, but as an event that will directly shape their financial lives. The helicopters have returned to base. The headlines will eventually fade, but the economic consequences will compound month after month, year after year, in ways both visible and invisible. Global events don't stay global for long. Wars, sanctions, and power moves always find their way into everyday life, into fuel prices, grocery bills, investments, and savings. If you want to understand how money really moves behind the headlines, you're in the right place. This is Professor of Money, where geopolitics meets your wallet. Subscribe, stay informed, and stay ahead.